One person, when you just told me your company is really focused on the the ARMs, but someone told me yesterday that it's not in favor because there's really no money anymore in it. Is that true? Tell me about the money that he's like, there's no demand, so the rates are not that much lower. Is that true or is he crazy?
Well, it's not that he's crazy, is that he's got to give you more context. So, like, the ARMs go off of a different treasury altogether. They go off the 5-year treasury. So, fixed rates go off 10-year treasury, all fixed rate products. Okay. The ARMs go off the 5-year treasury. So, as these treasury yields rise, the shorter term vehicles, the 5-year moves more aggressive. So when rates start popping higher, you start seeing the spreads tighten between the fixed and the ARMs. Now, in its best day, there can be a point, maybe 112 basis point difference. Today, it's probably a 62 bips to 75 basis point difference in rate, because the 5-year treasury moves more aggressively on the upside because it's a shorter term vehicle. Like, the 2-year treasury, the one that everybody talks about, recession, that's at levels we haven't seen in decades right now. So that's dragging everything higher. Now, no money involved. I don't know what that really means, because banks.
Well, he said they're really they're not in demand, or they're not being, I guess, sold in the securities markets.
No. Banks prefer ARMs. Banks prefer ARMs because you're locking up the money for a shorter period of time, period. That's why 5-year ARMs are priced the most aggressive, and then 7 and 10 and so on and so on and so forth, right? So banks prefer ARMs. That's why they give a little more juice or pricing specials on these ARMs, because they prefer those, because they're not going to tie up the money for a long period of time.
Okay, as an example, like, let's pretend today, I come to you today, what would be the difference between the standard 30-year fixed and a 5-year?
Well, a 5-year ARM today is, I priced one out for a jumbo mortgage, rather. It was 5 3/8, 5.375.
Okay, so 5 3/8 versus what, 6.75?
And you got 6.5, 6.625, right around there.
So we're talking about a little more than 1% over on a 500,000 loan is X dollars.
So the prices keep, they move, they compress, they go back and forth. That was as of this morning. I haven't, before the market opened, this was as of yesterday's pricing. I didn't price something fresh now, because the markets do release banks release new rates at 10 a.m. for the day, because that's when treasuries and the markets all settle. Then they release the new rates for the day. So I was just giving you yesterday's rates. The treasury yields today are getting crushed again. So, I would reprice that, but just that's a good example. It's about a
good example. So how does this work? I mean, yesterday, we finished a contract at 445, and what's so funny is you're talking hyper technical, and then the lawyers and the realtors are much more old school, like, Andy Griffith on the kitchen table. So 445, an email comes across the parties, and they print it and they run to you, and it's after the market. How do you get that? Via email, or someone knocks on your door and here's the paper contract? At what point do you actually lock them, because they've been pre-approved, so they're all, all about them? How does it get done?
I could lock a rate right in pre-approval status, and I could lock it instantaneously. So as long as I do it before 7 p.m., I'll get that day's pricing, period. So it's as easy as that. However, if you don't have an application with me and it's 5 o'clock, 6 o'clock, and you're still kicking tires around, then you're subject to next day's pricing.
Right, but you say an application. What if they didn't supply their financials in time? Or what if their financials are, or not complete, or or sketchy?
Well, again, that's a judgment call on a per deal basis. Unfortunately, that there's just no one rule behind that. The generic rules are, you submit your application for a pre-approval, you supply me with 2 years W-2s, pay stubs, bank statements, and so on and so forth, and I review your income. And then I determine if you can get pre-approval.
So really, and it sounds silly for me to say because I've been at this. So really, the pre-approval potential rate lock is all, of course, subject to underwriting. So if you're
Oh, yeah.
walking around, you say, Jason pre-approved me on a 5-year, 5.375, and you have dings, ding, ding on your credit, you're 615 FICO, then it just didn't happen, right? You didn't make it.
Well, there are certain levels at my level that we can determine. You see enough of if you see the movie Titanic, eventually it hits the iceberg, right? So you see enough credit profiles, what's going to be approved and what's not going to be approved. If it's going to be, hairy, sketchy, whatever the case may be. So I could see a credit profile. If you're just basic, I'm like, yeah, you unless you have something underlying that I have no idea about, you should fly. However, it's always subject to underwriting. I'm not an underwriter. I'm a loan officer.
Well, let me ask you this. Okay, and now that you said this, this is a world of its own, underwriting.
Mm-hmm.
The guy's all set. A couple of wife, plenty income, assets, credit, everything's great. You don't know that there's a lawsuit. You don't know that. You don't know that tomorrow there's a decision and order from a court and a resulting judgment, and then a resulting income execution, wage garnishment. Because I've had this happen. The guy's pristine, everything's great, beautiful family. Who knew that there's a $4 million lawsuit? And then he loses, he blows it off. Lawyers give him the bad news. It's now a recorded judgment. And he's really easy because he's a financial strategist. We know where he works. They hit his income. Now what?
That's it. No deal. Period.
What do you mean no deal? Because we're closing tomorrow and this happens yesterday, which you're not going to know about.
Well, I again, like, the customer has to tell me everything. If the customer kind of leaves stuff out and just crosses his fingers that we don't catch it, then that's the risk you face. You can't, that stuff is big. Okay, that stuff is big. So if it went past the customer, past the attorney, when they pull title, and they ran all sorts of municipals on.
But it might not. I mean, they're only going to pull title for municipal records, and it didn't hit the county clerk yet. But it is in a case.
I mean, that's again, like, it's something that has to be brought to light beforehand. If when customers, and I think customers are more forthwith now than they ever have been in any time in the past, because people used to keep stuff, to themselves and then hope that we didn't discover it. And that those are facts.
Well, that information is more, you're looking for financial information. This guy may not want to ruin his lifestyle, upset his wife, or, I know that's being a bit old fashioned, but now the kid's in the school. And what about this? What if he's selling his house and making $2 million or even 200,000 because he bought it in 2017? Now he can't buy and he's getting ready to realize the proceeds from his sale. Teach me, please. Unless it's a municipal record, you will not pick up on it. In fact, you never pick up on it. The title company would pick up on a municipal record. And actually, I don't even know if that would stop a closing because it would stop the sale because it runs with his. But what if he sold 2 weeks ago and now it's really just a personal debt, right? Maybe it wouldn't even run with the new property. I think it would run with the new property.
I mean, that's tough to really say. If the bank picks up on it, all I can tell you is if the bank picks up on it, it's going to be an issue.
Right, but according to what I'm thinking, and I'm ignorant, the bank would not come up with that because it's been nothing of a banking nature.
Yeah, look, assuming the bank doesn't pick up on it, then you're good. But that's not you can't like ask somebody. It's like, am I going to be good? I think you will be, but I don't know.
But let me ask you this: on the loan application, does it have any question regarding legal proceedings or any pending judgments?
Yeah, on the disclosures. I mean, on the declarations at the end, are you third party, are you party to a lawsuit, all that stuff. Yeah, there are those questions there.
So then that would be some form of fraud to not disclose that.
Exactly. By the way, a little funny one. Apparently, Rhode Island. I picked this up when I started working for Citizens. Apparently, Rhode Island had an arson problem uh, way back in the day. So one of the questions specific to Rhode Island was, "Have you ever been convicted of arson in the past?" I just thought that was funny. Um,
Well, can I tell you what's funny about that? I went to University of Rhode Island,
right.
and I know so many people from Rhode Island, and it is such a sketchy place that I completely believe that.
I was like, they just added a question to the declarations. That's just a very, hey, have you ever been convicted of arson in the past? If you
Not
say yes,
any.
then no deal.
It's kind of funny because no financial anything, just something like that. Wow.
Very specific to Rhode Island, yeah.
Interesting. But I mean, these are some heady issues, and I love talking about it. But really, we talked last time about that. I call it the Advantage program, where the seller would allocate funds that otherwise would have been chopped and would do nothing for either party towards a buyer's points, and within the deal, it makes the house more attractive, and it makes the buyer easier, have an easier time to buy. And outside the transaction, this is the realtor that you should pick because he or she has this strategy that Jason can more than amply support and implement. And even more so, you mentioned that an ARM might better serve you. So you're really, if you count the use of an ARM and the discount points, you're talking about a big difference. In your case, the 5 whatever would be for something, right?
Oh yeah. Look, I mean, you have to play the fact that since nobody really rides out a product past 5 to 7 years, you can kind of wipe out the 30-year fix, or you can kind of rule that one out as a product. Now, those rates are obviously high. Those are the benchmarks. Everybody kind of just defaultly shifts in that direction for some reason. And, I understand why. So, the 5, 7, and 10-year ARMs are much better plays, and the buy downs, you can really buy the rate down even further. And if you take a 7 or a 10-year, you can just wait out an interest rate cycle, because like I said, they will cycle down ultimately. It's not a question of if, it's just a question of when they will do that. We're just in a rising rate environment now, so that just kind of scares people when it comes to ARMs. But in reality, it's nothing to be really afraid of at all.
So the ARM to me is an improvement to the approach that we discussed, which is the allocation of funds with no harm to either party, versus what we discussed is the 3-to-1 buy down, where you mentioned there's some sticker shock and some really inherent problems, and I agree. And some of those are outside your control. You could control how much sushi you eat or Disney, but you can't control taxes,
right,
or insurance. A friend of mine told me insurance has gone up. His insurance went up 40%. So there's no way to control that. And then there's also the friction where you're having professionals and parties attempting to participate in this 3-to-1, telephone game down the line, ABCD. And it's also to some extent adversarial because buyers are going to be offering maybe full price without any reduction. So how could a buyer expect to get a seller to contribute when others are not?
How can a buyer? I mean, that's a tough one. That you have to. I think you have to rely on the agents. Especially the selling agents to have that hard conversation with their seller, and that's what's important. What I find is nobody likes to have hard conversations. Everybody wants the easy conversation, and nobody wants to have a hard conversation. And I think they need to have that. You got to have that.
But even if you're right, that hard conversation would only come if prompted. If it's not from the seller's agent's initiative, it only comes if it comes like rain. So to get to the seller's agent or the seller's ears, it means it has to be properly presented and actually believed in. And here's the kicker. A lot of buyers don't even need it. This is preferential. This is not necessity. This is, oh yeah, I'm buying a house, I'll pay the rates. Everyone thinks that. They're not even aware that a possibility exists because we live in a world of no points, ecosystem.
Well, all of it's preference. You don't want to, this transaction, you can't, it shouldn't be by necessity, because if it is, that becomes another issue altogether.
Well, what do you mean? The family going from one house to the next. I don't mean this strategy. I mean, buying a next house is move up, empty nest. All those things are necessities. So you're
well, no, the strategy itself to make it work. Like if I don't get this 3-2-1 buy down, if I don't get the seller's concession,
right,
then the deal is dead. Like that's what I meant.
Oh yeah.
That's what I meant by necessity. That's more of just a luxury.
That's a preference if possible. I get it.
Yeah, that's just to sweeten the deal.
But if we really, collaborate and we lose the adversarial approach here, and when the market was, it's now what, March 2023, just for our audience, when things were just kicking, transactions could be even adversarial because these sellers and listings were divas and thought, it'll be sold in 48 hours. So you didn't have to be in any way collaborative. It was no real communication.
Oh yeah. Like, these strategies wouldn't have mattered what type of strategy you had, because if it was something that the selling agent or the buyer, whatever, didn't understand, they would just, I'll just move on to the next one because this hurts my head thinking about it, so.
Right. Just like I'm sure you experienced with VA or FHA. Oh, FHA, they needed gutters, they needed handrails. Let's stay away. That was a whole thing.
Yeah, because you had that luxury of just next batter, next one up, next
man up.
But that's not the case anymore. I mean, inventory is light, so it's just a weird dynamic in the housing market. But that's just not the case anymore. You because these rates went to where they went to, you lost the pool of buyers. Whatever that amounted to. If you were in that, $600,000 to $800,000 range, which I think is average for the New York metropolitan area, not including Manhattan, then if a 7% rate really knocked your price point down a little, and then you've lost the pool of buyers, so you just didn't have that luxury. But right. What's keeping these home prices afloat really is the lack of inventory. So
right, but to me, we discussed this 4 things that the lack of inventory is really because people are not going to leave their normal rate post-COVID market. Now you have the 3% rates that they're sitting on. They're laughing all the way to the bank each month. They're not selling. The other 2 constants are the mortgage tax in New York City. That's not changing. And the other constant is the rate. So unless it dramatically changes, there's a battle on several fronts. So I think you really need sellers who wish to prosper to, the more I think about it, I walk around thinking about it, I go, this should be the standard. This advantage program should be the standard. It always, as the SEMA, the consolidation, is done in 100% of commercial deals. It is the standard.
That's the standard out here too. In refinancing, even in buy purchase SEMAs as well. They're done a lot. I actually, when I speak to the attorneys, I suggest maybe try to do a purchase SEMA, save your client a few dollars here, if you're able to.
But that takes time. That takes some time, and it's not always possible, and it does have costs.
They do. So you got to weigh out you have to measure out the economics, see if it's worth it. Most SEMAs now can get done in a reasonable time simply because volume is just not what it once was. So, all SEMA is acquiring all collateral docs. It's not, they make it sound so sophisticated. Consolidation, extension, modification agreement, SEMA, but it's really just collateral documents being.
It's getting the docs and then executing the agreement and then just saving money, right?
On a refi, it's
but the loan is underwritten. Am I correct in saying that a loan is underwritten differently with a SEMA than other?
Not necessarily, no. Unless assets are an issue, and you need your assets. Unless you have an asset issue, then you know, if it's underwritten, you can say, well, they're not going to pay XYZ in mortgage tax, so they won't be short to close, stuff like that. So, but it won't necessarily, because again, a SEMA should be more of a luxury item than a necessity. You know, if I can't buy this house because I have to pay mortgage tax, that's a problem. You know, I'd prefer not to pay mortgage tax or waive some of the mortgage tax, but you know, if it can't be more, it can't be a necessity. However, if you're underwriting a file and I need the SEMA to make this work, that's when you're on pins and needles, because what if the SEMA is not delivered on time? What if the bank can't find the collateral docs? What if?
Right, there's that, and that happens. And then if you want to get one more step higher, New York has the mansion tax, which I think it was 10,000 above $1 million, but I'm not sure. I think it may have gone higher based on 2 million and so on. I cannot say for sure.
Yeah.
So you have that.
But yeah,
I know that was
the mansion tax. Pretty much every transaction in New York has mansion tax. Well,
right.
Manhattan.
And Eastern Long Island has the Peconic tax. So I was involved in the deal, and it was about $55,000 before we got to closing costs. Mansion tax, Peconic tax, and mortgage tax. And the guy goes, "What am I closing?" I said, "Well, these three are 55." He goes, "What?" Because of course, no disrespect to the realtors, that was not even mentioned.
Again,
but every closing is going to require that.
Yep. Yeah. I mean, if you don't like as a bank, you know, we absolutely have to disclose those items. You know, for the most part, as a bank, we tend to over disclose on closing costs. You know, obviously.
That's a good idea, but unfortunately, some people only get to the bank after they have an accepted offer.
Right, but you know, you got to know your area, and you got to know the people you're working with, and if there's Peconic tax, I got to know that. I've seen that slip up so many times. I can't say that I haven't done that once, you know, about a decade ago, and I never made that mistake again, you know, because I just didn't realize there was Peconic tax.
Would you know that? Do you know that I successfully avoided the Peconic tax? I was the last few weeks of 1999, and I was in a phone booth, a phone booth, arguing with the lawyer, Eastern Long Island, and I said, I got to get this done. I don't even know if he or she was aware. And I said, I said, I got to get this done. It has to be notarized. And I think you had to file a contract for it to be acceptable prior to the implementation of that tax. Oh, 1999. Yeah.
The silent killer. It's Peconic tax. I always call the silent killer, because you just don't know. Like if
it's a lot. It's a lot. Yeah. I remember. So it's a lot. So, you know, you're dealing with high net worth, and that, you know, that generates that crazy tax base. But I want to tell you, know, what we got into this, but I really think that this is something that you can easily, maybe with some of my facilitation, demonstrate to agents that this collaborative approach is the winning formula, where if they realize that their clients can really benefit, and down the line, a buyer, I mean, think about this, a buyer's looking for a property, he's pre-approved, never does he or she imagine that they could experience a lower rate. They never know. So that's like that's a really fantastic thing to learn. And the seller looks great, and the listing agent looks great for bringing these parties together. And there's a gain for everyone. So this is educational. This is implementation of a strategy. I think you should be the purveyor of this information and demonstrate it's really done just through, and eliminates friction. I mean,
it eliminates friction. To your point, it is super educational. It gives the customer something else to look at. It gives the agents something else to look at, rather than the proverbial, hey, don't pay points. You know,
it gives every seller a chance to talk to people about the possibility of them gaining without the pressure of a sales call. It's you're marketing yourself far before anyone even is in a deal. So the listing agent or any agent can talk to buyers about this, to make the request, to go in thinking this is a possibility, and realtor talking to any seller possible to get the listing. Hey, pick me because I have a strategy that no one else uses.
Yeah, bridging the gap. That's what I like. I call it just bridging the gap. You know, there's always a gap to some degree. There's always a stalemate, and if you can bridge that by getting creative, you know, where everybody wins, then yeah, and then you look like a superstar. The agent will look like a superstar too. You know, the agent will just say, "Hey, my strategy," so they'll feel good about it as
No,
well.
right.
So
Their strategy, because they're the ones explaining. You're not going to be there at 7 o'clock at the kitchen table. So it is their strategy. But I mean, so is brushing your teeth, you know, so you can teach them that one strategy, or maybe they could return to you as a resource, or, you know, we could get some attorneys on these seminars and say, yes, here's how it looks. Maybe you could bring an underwriter on and show this is not fiction. This is simply an agreement.